You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Today, we are going to look at Propel Holdings, a business, a stock that went up 350%, showing total return 350%. That's not a mistake over the past 3 years. Kind of crazy, right? So what is behind this high growth stock? So of course, it pays a dividend. It started to pay a dividend not too long ago. So it's a fairly new business in the dividend growth world. The yields at 2%. The market cap is 1.3 billion. So we are talking about a small business that is definitely growing very, very fast. So what's the business model? So Propel Holdings is a fintech, so using AI to provide installment loans and lines of credit. So they're using AI to accelerate the underwriting process. So the underwriting process is like when you determine whether or not you should give a loan or a line of credit to a consumer. And they focus on, of course, customers that were neglected by banks. You can imagine that if they have been neglected, probably it's not the best payers in town, but they have developed an AI model where they can scale fast, provide those loans, and hopefully not taking it in the teeth when there's a recession. So that's the whole business model. They are expanding also in the US and in UK as well. So they're not just in Canada. So they're trying to go very fast, and they offer multiple like lending branding name, if I could put it that way. So you may have seen Credit Fresh, for example, that their operation is usually to partner up with banks and providing online lending solutions. So very easy, like the type of thing that you get your loan within a few clicks and then boom, you get access to credit. They also have Money Key in the United States. So they're trying to grow on both sides of the borders, and they also expanded in the UK. So the narrative, as you can tell, is quite interesting, quite seductive. I mean, we keep on talking about the rise of AI and companies using artificial intelligence to automate so many different parts of our lives. Well, Propel Holdings is doing it in a very smart way. So far, their proprietary platform has been providing great results, and it's of course highly scalable. I mean, once you have built a model that can think for itself, I mean, you just build the interface, the platform where customers can go online, enter their information, and then boom, the AI is doing all its works. I've used to work in credit at the very beginning of my career in the financial industry, and I can understand that in a lot of cases, the credit officer that was allowing or declining the loan pretty much just follows a simple set of rules. So, and unless you have like very highly complicated cases that of course need like a credit underwriter, probably that you can pull out a system that would just follow those rules and use AI instead of that. So very highly scalable, the good margin of profits. Propel is also growing by acquisitions. It's expanding not just in being in Canada, but expanding in the US, in the UK, as I just told you. So there is a lot of growth behind it. So we have the playbook. Super simple, AI fintech, get your loan online, super scalable. The growth vectors is the growth by acquisition, getting more loans, getting more profits. The moat, I mean, there is a moat. There is a moat in the sense that they own their proprietary AI model, but let's be honest, you can probably copy that if you just spend a little bit more time on it, especially if you're thinking about the resources from big Canadian banks. probably that if they decide to go that route, they could build an AI very fast that could compete against Propel Holdings. Do they want to do that? That's another story, but that's pretty much the only moat that this company has. If not, I mean, they're actually fighting with a lot larger companies than they are. And they're lending money, so it's just like loans and lines of credits are commodities, so it's not necessarily something that, and you don't even build a relationship because you go online, so you go for something fast, something easy. That's their main power, so not so much for the economic mode. In terms of numbers, I mean, if you look at the dividend triangle for this one, so you look at the revenue trend, earnings per share, and dividend growth, it's just crazy. It looks like a rocket ship that is like going to the moon. So the revenue not too long ago was around 73 million. Now it's like 500 million, on pace to reach 500 million this year. Earnings per share in 22-23 around 20 cents. Now we're talking about $1.40. Like huge growth once again. First dividend was paid in 22 for 10 cents a share. Now it's at 17 in 25. So almost doubled in 3 years. Kind of crazy as well. So when you look at those numbers, you're just like, wow, the narrative is sexy. The numbers are sexier. So just take my money and run, right? I mean, I want to buy this stock. Well, not so fast. First, I would say this is the type of business model that looks good on prom night, which means when consumers are looking for loans, but they have this ability to pay because they have a job and they're not in a recession, well, then this is the type of business that is going to make a lot of money. However, if we go into a deep recession where people lose their jobs, it's not going to work well because they also focus on clients that are not, let's put it that way, they're not A-plus clients. So they come with a little bit more risks. So if they lose their job, well, boom, you're going to see the net charge-offs going very high. So you have to look into the provision for credit losses every single quarter just to make sure that you are not taking additional risk and that Propel underwriting process is still in line with their projections. There's a lot of risk when you lend money to B or C clients. Of course, the other thing is you have to rely on your AI underwriting model to make sure that it's still always making sense. That's pretty much their only competitive advantage, though, from the way I see it. So you have to be careful with that too. It could get crushed easily, especially because when you consider the market cap size of Propel, we're talking 1.3 billion, as I said in my intro. Compare that to Royal Bank at nearly 250. They could literally buy Propel, close it down, and not even realize that they actually wrote a check to buy it. So they could go against that and then compete, or they could just buy the model and that would be the end of it. So the competition there in this world is quite fierce in the financial industry. Big banks are there. So, and you cannot really compare Propel Holdings numbers with the big six. The last thing that I want to highlight, long-term debt is also skyrocketing. So we are talking about like 50 million about 5 years ago, and now up to 250. So again, I have to be careful with that because it's not 5 years ago, it's since 21. So it's a very young company, brand new on a lot of things. And they of course, to finance that growth, they need more debt. But this is the kind of recipe that could turn sour very fast. So just want to highlight those risks. It is not for the faint of heart. Of course, small cap companies will fluctuate very fast. If you look at the stock price, actually, yes, it skyrocketed. But I mean, not too long ago, at the beginning of 2025, it was trading above $40. After Liberation Day, it went down to around $23, and now it's back to $33. So you can imagine that's only over the past 5 months. So $40, $20, $30. That's just normal for this type of investment. So if you buy and you're up or down like 20, 30% within 3 months, it's normal. You have to Be careful about that. So if you don't want to have this kind of roller coaster, I suggest that you start your research using the Rockstar list. The Rockstar list is a list of companies that shows positive dividend triangle. So they are thriving over the past 5 years, showing revenue, earnings per share, and dividend growth. This list is updated monthly, so you can download it for free at moosemarkets.com/rockstars. moosemarkets.com/rockstars. All right, Moose, that's enough for today. Tomorrow, we're going to talk about spending more money at retirement because this is what you should be doing. Like, don't restrain yourself. So we're going to talk about that tomorrow. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.